Possible exit strategies. You've launched a startup, grown it, perhaps even scaled it to impressive sizes. Congratulations, you've created something valuable. But what's next? Every founder and investor at the beginning of their journey thinks about an exit strategy in one way or another. This doesn't mean abandoning your brainchild. It's a plan for how you and other stakeholders, co-founders, employees with options, investors, will monetize your stake in the company. An exit strategy is not a sign of failure or lack of faith in your product. On the contrary, it's part of strategic planning that shows investors you are thinking long-term and understand how they will get their returns. For you, as a founder, it's an opportunity to be rewarded for decades of hard work, sleepless nights, and risks. Let's explore the main paths your startup can exit the game and what each one entails. Selling the company, mergers and acquisitions, M&A, a new home for your brainchild. Selling a company or mergers and acquisitions, M&A, is the most common exit strategy for most startups. This is when another, typically larger company acquires your startup. This can be either a friendly merger or an acquisition. Think of it as a baton pass. You've successfully run a certain leg of the race, and now someone else will continue the run, using your technology, customer base, and team. Why do startups get acquired? Monetization for founders and investors. This is a direct path to returning investments and realizing profits. Resources for scaling. The acquirer often provides vast resources, financial, marketing, human, infrastructural, that a startup would find difficult or impossible to obtain on its own. Increased reach. Your product or technology can gain much broader reach by being integrated into a larger ecosystem. Exit from the rat race. Managing a startup is constant stress and a race for survival. An acquisition can give founders a chance to rest, reset, or start a new project. Strategic acquisition. Large companies often buy startups not so much for profit, but for their technology, talent, known as acqui-hiring, customer base, or to eliminate a competitor. Finding buyers. Who might be interested in your success? Large players in your niche, competitors or companies that operate in related fields and could expand their product line or customer base through you. Tech giants, companies like Google, Apple, Amazon, Microsoft, which are constantly looking for innovative technologies and teams to strengthen their positions. Private equity firms. They acquire mature, profitable companies to optimize them and then resell them for a profit. For startups, this is more relevant at later stages. Ecosystem partners, companies you already collaborate with, for whom your technology or service is a valuable addition. The due diligence process. Skeletons in the closet or clean and tidy. Due diligence is a comprehensive review of a company by a buyer before completing a transaction. It's like a medical checkup before a major surgery. The buyer wants to ensure everything is clean, with no hidden problems or risks. What is checked? Financial statements, revenues, expenses, profits, cash flows. The buyer wants to verify the accuracy of your financial data. Legal aspects. Correct legal entity formation, possession of all licenses and permits, compliance with labor laws, absence of lawsuits, correct intellectual property registration, etc. Technology and product, code quality, architecture, scalability, presence of technical debt, product development plans. Customer base, retention metrics, customer loyalty, reviews, growth potential. Team, qualifications of key employees, their contracts, incentive system. Contracts, with suppliers, customers, partners. How to prepare. Maintain impeccable records. Financial, legal, operational. Create a virtual data room where all documents are organized and accessible. Fix problems in advance. If you know about any legal or financial skeletons, it's better to resolve them before starting the sale process. Hire professionals, M&A lawyers, and investment bankers for larger deals will help you negotiate, structure the deal, and navigate due diligence. Selling your company can be a quick and effective way to monetize your efforts and give your product a second life within a larger structure. IPO, initial public offering. Stepping onto the big stage. An IPO, initial public offering, is when a company first offers its shares to the general public on a stock exchange, e.g., New York Stock Exchange or NASDAQ. This is the culmination of a startup's growth, transforming it from a private company into a public one, accessible for investment by anyone. Why do companies go public? Raising vast capital. An IPO allows for raising much more capital than through venture rounds. This money is used for further growth, expansion, and new acquisitions. Liquidity for investors and employees. Investors and employees holding options or shares gain the opportunity to sell their stakes on the open market and monetize their investments. Increased visibility and prestige. The status of a public company significantly enhances its reputation, brand recognition, and attractiveness to customers and talent. Access to future capital. After an IPO, it's easier for companies to raise additional funds through secondary stock offerings or bond issuance. A complex and lengthy path, scale and maturity. An IPO is for very large and mature startups with proven profitability or very strong growth and potential. It's not an option for the early stage. Regulation and transparency. Public companies are subject to much stricter regulation by oversight bodies. This means extensive reporting, auditing, and transparency requirements, which significantly increase operational costs and legal burden. Cost. The IPO process itself is very expensive. It includes the services of investment banks, underwriters, lawyers, auditors, and PR agencies. Market volatility. The success of an IPO depends heavily on the overall stock market conditions and investor sentiment. Main stages of an IPO. Preparation. Several years before the IPO, the company must build its corporate structure, strengthen financial reporting, and hire a team of top managers with experience in public companies. Underwriter selection. The company hires investment banks that will manage the IPO process, value the shares, and sell them to investors. Documentation. Preparation of a vast volume of documents, including the S-1 in the U.S., registration statement with the SEC, which contains detailed company information. Roadshow. Company management and underwriters conduct meetings with large potential investors, presenting the company and its prospects. Pricing and allocation. Determining the share price and selling them to investors. Trading commencement. The company's shares begin trading on the exchange. Example: Google, Alphabet, which went public in 2004, and since then its shares have shown phenomenal growth, making many of its employees and early investors millionaires. An IPO is a symbol of great success and enormous opportunities, but it is also a long and complex path, suitable only for a select few. Long-term ownership and dividends, the long game. Not every startup aims for an acquisition or IPO. Some founders and their early investors choose a strategy of long-term ownership, preferring to grow the company, extract profits from it, and possibly pay out dividends. This is a strategy focused on creating a sustainable, profitable business that can exist for decades, providing stable income to its owners. Why choose long-term ownership? Full control. Founders retain full control over their brainchild without being subject to the demands of the public market or a new owner. Focus on sustainability, not exponential growth. This strategy allows for focusing on profitability, product quality, and customer satisfaction rather than investor pressure for rapid scaling. Dividends. If the company generates stable profits, it can pay out a portion of these profits to its shareholders in the form of dividends. This is a regular income for owners. Legacy. For many entrepreneurs, it's important to create a company that will exist for a long time and impact the industry or society rather than simply being sold. Example: Basecamp, formerly 37 Signals, is a prime example of a company that successfully developed project management software without raising venture capital. They always focused on profitability, a small team size, and creating high-quality products, paying dividends to their founders and employees. They never aimed for an IPO or sale, choosing a path of sustainable organic growth. Nuances of this strategy: no large payout. This strategy does not provide a single massive payout like an acquisition or IPO. Monetization occurs gradually through dividends. Less liquidity. Shares in such a company are less liquid than shares of a public company. They are harder to sell if the need arises. Investor expectations. If you raised venture capital, investors will expect an exit through M&A or an IPO. Long-term ownership is most often possible if you started with bootstrapping or raised funds from angel investors who share your vision of long-term growth. Choosing an exit strategy. There is no right or wrong exit strategy. The choice depends on your personal goals, ambitions, the type of your startup, its market, and the preferences of your investors. It's important to think about this from the very beginning and discuss it with your co-founders and investors.